Okay. Jackson, let's do it from the top. What's number one say up here?
In today's presentation, general in nature? You bet.
Okay, two.
Are there multiple sets of rules that interact with each other and are nuanced and not straightforward? You bet they are.
Number three.
With that in mind, what is the goal today? And it is to introduce M1s, and that M1s result from accounting methods that are required for tax versus how income and expenses are recorded for financial statements.
And I think Chris said he had some inkling as to M1 item, or what an M1 is, and what it more of what it does. What's an M1?
So I can give you an example. So if a business depreciates assets on a straight line basis, but for tax purposes they use makers to reconcile taxable income to book income, we have to use an M1 to balance the balance sheet.
Okay. How do you feel about that, Jackson?
Makes sense.
Makes sense. Makes sense, Max? Sam, makes sense? It does?
I don't know.
There you go. There's only two answers, right? So I'm probably getting ahead of myself as usual. Well, let's take the guided tour and see where the hell it goes. Sam, what's number four say?
Let's start with a more fundamental question. What is an accounting method? An accounting method is a set of rules to record a transaction. Is there an accounting method that was utilized in the creation of the financials that are being utilized? The answer to that is yes. Does the IRS allow a taxpayer to use any accounting method in the preparation of a tax return? The answer to that is no. If you have a method used in preparation of financial statements and the IRS requires in certain instances a different accounting method, then there are differences in the accounting methods used for financial statements and tax returns. The difference in methods results in an M1.
Okay. So I think what Chris was saying, and correct me if I'm wrong, Chris, is that a company bought an asset for $10,000, correct? And in a straight line over 5 years, that's $2,000 a year of depreciation. Is that correct so far? Am I tracking with what you're saying, just putting numbers to it?
Yep.
Okay. That same asset, so this is GAAP. That same asset for tax has $10,000, but we have bonus depreciation. And I'm going to go back to the good old days where bonus depreciation was 100%, and I feel good about my math at that point. Okay? So for bonus depreciation, I have $2,000 a year, correct? For 5 years. 1, 2, 3, 4, 5, correct? Bonus depreciation, and then 0, 0, 0, and 0, correct? I've taken $10,000 of depreciation associated with that asset. So what this is saying is, well, is there an accounting method for book? What's the accounting method for book? It's taking the $2,000 a year depreciation on that asset. That is the method for book. Is there an accounting method for tax? Yes, there's an accounting method for tax. And due to our ability to take bonus depreciation in year one, we took all $10,000. Okay? So I'm going to pretend that we have $100,000 a year and for GAAP, we have $2,000 of depreciation, and we have $98,000 of GAAP income. So now we have to figure out, well, wait a minute. I have a tax accounting method, and I have a GAAP accounting method. Embedded in my $98,000 number is a GAAP accounting method for depreciation. So I'm going to do, you can do this one of two ways, okay? And I'm going to do it the long way for illustration purposes. I'm going to back out, take an M1 for GAAP depreciation, and I'm going to add back that $2,000 because I don't want it in that number anymore. I'm going to push aside the gap amount out of my tax calculation. And then I'm going to say M1 for tax depreciation. And that's going to be negative 10,000 because that's my depreciation number. My taxable income is $90,000 because I'm using a different accounting method for GAAP than I am for tax. But in year 2, this is year 1. Year 2, I have $100,000 of income, and I have $2,000 of depreciation, $98,000 of GAAP income. Chris, is that exactly the same as it was the year before?
Yep.
Yep. So now I have to follow the same procedure. I have to back out my GAAP tax, or my GAAP depreciation, $200,000. How much tax depreciation do I have, Chris? 0. So in year 2, I now have $100,000 of income. An M1 item is meant to calculate what the appropriate tax method of accounting is to arrive at taxable income. That's what an M1 is. Did I do a good job, Chris?
Yep.
Okay. Okay, who read last?
I did.
You did. Who you want to call on, Sam?
Allie.
Allie, what's number 5 say here?
What are examples of accounting methods? A, cash basis. B, accrual basis. Accrual method of accounting can be broken down into many subcategories. Deferred revenue, vacation accrual, accrued bonuses, bad debt deduction, depreciation and amortization for gain or loss on sale of asset, deferred compensation, non-qualified stock option,
ISOs. Yep.
Deferred compensation arrangements, reserves, inventory and warranty, and then change accounting 481A adjustments, and then C, permanent items, meals and entertainment and life insurance.
Okay, so the point of this is these are examples of possible M1 items where we're going to account for something for book differently than we will for tax. And I'm pretty sure we're going to go over some of these. Allie, who you want to call in?
Chris.
Chris, what's 6 say?
To understand the difference between the accounting methods, would it be a good idea to think about it from 2 different point of views? A, income recognition, and B, the ability to recognize an expense.
How do you feel about that? Would it be good to understand, to know how we recognize something for GAAP purposes and how for income purposes? In the category of income, would it be good to know how we recognize something for GAAP and how we recognize something for tax?
Yes.
Okay? So, an example, actually, is, did we talk about installment method this morning?
Yes.
We did. Do you think that if a company sells something on the installment method, do you think GAAP recognizes the installment method, or does it recognize all the income in year 1?
I'm assuming year 1.
They recognize it all in year 1. Do we have the ability to defer that income for tax? We do, under the installment method. And how did you define installment method there, CB?
In chunks.
In chunks. We're going to give payments in chunks. Okay? So you have to be able to recognize, or Sam, diagnose what's going on by virtue of knowing installment sale rules exist for tax, but they don't for GAAP. And what about the ability to recognize expenses? Do you think there's differences there? There are. So for GAAP, an example of that would be, Jackson, earlier I put $10,000 into a bank account and said, it's yours because you rendered the service, but you're not going to get it 5 years from now, until 5 years from now, right? Mm-hmm. And you said that that's not income to you today, correct?
Correct.
Do you think that's a GAAP expense?
Yeah. Yes, for
Yes.
you it would be, because you.
It would be a GAAP expense. So understanding that for GAAP, deferred comp that I put aside, it's Jackson's, but he can't get it for 5 years. He's not going to recognize that income for 5 years, but I'm going to take an expense for it. Now, if he's not going to recognize for gap expense, if he's not going to recognize it for 5 years, do you think the IRS is going to allow me to get a deduction for something I haven't paid him yet? The answer to that's no. So understanding the variance between how something is accounted for GAAP and the variance or the alternative accounting for tax is something that you should develop as a skill to spot when I have to have an M1. What's consistently treated as book and tax being equal and what's not consistent. And this list of items that Ali so eloquently ran through are opportunities to treat something differently for GAAP than it is for tax.
I would say lean on the auditors in the office as you work through that stuff, because you don't need to be an expert in GAAP by any means, but
I agree, yeah, 100%.
you need to know and understand how they're treating certain items before, you can make an assessment on anything new, so.
100%. So, an example of that, and tell me if I'm restating this correctly, Austin, is that if you need to know, there's a concept of deferred revenue. That probably would be a good example of what you're talking about. Deferred revenue for tax purposes, and there's actually an example in here, and we're going to talk about deferred revenue. Deferred revenue is, Jackson, I'm going to pay you $10,000, but you're going to do something for me over a 3-year period, a subscription something, okay? Well, on your balance sheet, I gave you $10,000 of cash, so you're going to debit cash, and you're going to credit deferred revenue, okay? So now, for GAAP purposes, they have to ask themselves, how much of that $10,000 am I going to recognize in the GAAP financial as earned? And to Austin's point, you have to understand how much they put into the P&L to figure out what you have to go back to this. I have to back out the GAAP number because I'm not going to utilize the GAAP accounting method, and then I'm going to add in the tax number or subtract or however that works to come up with that difference. So to Austin's point, you have to understand what is that GAAP number that I have to pull out. And I think you're saying, don't reinvent the wheel. Especially with gift cards, I hate deferred revenue. With all my soul, I hate deferred revenue, okay? Because of this complication, and when you buy and sell a business, deferred revenue is a ginormous pain in the butt, okay? So for tax, and we'll get there, is we get deferred, and I'm going to change to 9,000 because my math is going to be easier, Jackson. We're going to recognize that 9,000 over three years at $3,000 a year. What tax says, and we're going to talk about it, but this is worth knowing, the tax accounting for that says, hey, to the extent in year one the financials recognize that revenue, you have to recognize it for tax. Under that example, Jackson, how much revenue did you recognize for GAAP?
3,000.
3,000. So I have to recognize that for tax. Then it says you can defer the rest of it for a period of 1 year. So while for GAAP it's being recognized 3,000, 3,000, 3,000 year 1, 2, and 3, for tax it's 3,000 in year 1, 6,000 in year 2, and 0 in year 3. So that's a great example of you'd have to go to the auditor and say, okay, how are you recognizing this 9,000? 3,000 a year. And here's where the pain in the ass gets, is do you think you have deferred revenue 1 year? Or do you think you have it every year? Every year. So now you got a new layer of 9,000 the next year that you're recognizing 3,000, 3,000, 3,000. And now you have to go, well, for tax, for that layer, I have to recognize 3,000, defer 6, and now I have to combat what was happening the year before. And now you're reconciling what the hell is going on with the deferred revenue. Chris, did I say I hated deferred revenue?
Yes.
Do you now understand why I hate deferred revenue?
Yeah.
Yes. But it's something that we all have to confront and deal with. Do we not, Austin? Yeah. We do. Let's see. Chris, who you want to call in?
Carter.
Carter, what's 7 say?
What concept do you use to analyze income and expense recognition point of view? My favorite answer, it depends.
So this is the cosmic third answer that Austin brought up. It depends. And we'll demonstrate how it depends. Connor, what's 9 say?
How do you analyze a recognition of income and expenses for a cash basis taxpayer? For income tax purposes, the income and expense are recognized on the tax return when either cash is received or when cash is paid.
Okay.
How do you analyze the recognition of income and expenses for an accrual basis
Oh, no,
taxpayer?
no, we're going to stick on the other. Sorry.
Oh,
So stupid question, Carter. If you do business for me and charge $10,000 for that service, your GAAP financial is going to say how much money did you make?
10,000.
10,000. How much money did you receive? I haven't paid you yet.
0.
0. So cash basis accounting is a measurement of how much cash did I receive. So, and we're going to do this as a preview. This is a preview to something that we're going to do. But saying it out loud more than once, repetition is good or bad, Carter?
Good.
Good. Okay? So, stupid question. You said AR was 10,000, equity was 10,000, P&L 10,000. That's what you said, right? Is that correct so far?
Yep.
Yep, it is. Okay? So now it's this M1 item comes into play. Well, how much GAAP AR is in there?
10,000.
So I got to back that out, don't I? How much cash or tax did I receive? How much money did I receive? 0. So that's 0. So from a taxable income perspective, I got 0 taxable income. So this is the reason I'm doing this. I'm going to get us to year 2. I'm going to say, Connor, that you have now cash in year 2 of 10,000, AR of 20,000, equity of 30, P&L of 20. Does that math make sense to everybody? From a debits and credits standpoint, does that math make sense that I got a $20,000 P&L? It does? Okay. So now let's do our M1. The way this works for cash basis is you have a beginning AR amount. What's my beginning AR amount, Carter?
10,000.
10,000. What's my ending AR amount?
20,000.
20,000. So you have this fluxing or comparing the two. So 10 minus 20 is how much?
Minus 10.
Negative 10. My beginning P&L was 20. My M1, or my timing difference, because I have a different accounting method for tax than I do for GAAP, gives me negative 10, end at 10. So stupid question, Connor. How much cash is on that ending balance sheet?
10,000.
10,000. So you can see how this M1 allows you to say, this is how much cash I harvested, and that's how much I'm taxed on. Okay? Who you want to call in?
Connor B.
B or V?
V.
V. I heard B. I'm like, oh, I don't think that says M. Connor V. What's 9 say?
How do you analyze the recognition of income and expenses for a cash basis taxpayer? Number 10.
Come on.
We did 9. Number 10.
Yeah, 10. Sorry.
How do you analyze the recognition of income and expenses for an accrual basis taxpayer? In general, you use the all events test. This is terminology that you may want to explore. Try Googling. What is the all events test? This test primarily focuses on whether an accrued liability can be deducted on a tax return. There's a 3-pronged test. The first prong is all events have occurred to establish the ability. Second one is the ability can be determined with reasonable accuracy. And number three, economic performance has occurred.
Okay, just for the hell of it. Okay, all right. There is a lot. There is a lot in number 10. So let's, I don't know if I have this somewhere, but this is worth knowing. Okay? I'm just going to call it other for now. I don't have a better word. Okay? So, question 1, have all events occurred to establish the liability? Have I performed the service? Have you and I interacted with each other in a manner that sets that liability? Does anything else need to happen? That's a good way of saying it. Does anything else need to happen? If nothing else needs to happen, the all events test portion has been met. Can the liability be determined with reasonable accuracy? Generally, that's going to be true. The last point, though, economic performance. That's the trick. Okay? Economic performance in measuring whether you have a liability that you can accrue for tax purposes is the trick. Okay? And for goods and services, economic performance, and I'm quite confident now that I'm saying this is in here somewhere, and we'll go over it. And so the fact that we have a preview, I don't care, because Carter, repetition is good.
Good.
Right? So it's when delivered. It's that simple. When a good or service is delivered, then economic performance has been met. Okay? Then there's this other piece. And this other piece, I'm going to call, God, I wish, there's a series of them, and I'm going to give you some examples. Warranties, which I think is in here somewhere. Tort, which is a lawsuit. Games and prizes, and there's some other things, okay? So, economic performance in this other category only when paid. Economic performance for a good or service is, the economic performance is met when the good or service is delivered. With these other items, which include warranties and torts and some other things, and I'm sure it's in here somewhere, it's only when paid, okay? So why is that rule there, that economic performance for deductibility for tax exists only when paid? Why is that rule there? Well, let's call it the GE rule, okay? I'm pretty sure it was GE, actually. GE was sued for, I'm going to say, $30 million in 1960-something. Okay? So, stupid question. Were you the last person, Connor? Who was? CV, who you want to call in?
Sam.
Sam's writing. Let's leave Sam alone.
I'm ready.
Luke.
You ready?
I'm ready.
All right, Sam. Has GE been sued? Yes. Did they lose the lawsuit? Yes. Are they required to pay the amount? Yes. Does it feel like all events, everything that needs to occur, has everything that needs to occur has occurred to say GE has to pay?
Yes.
Yes. Can we determine the liability with reasonable accuracy? They owe $30 million.
Yes.
Yes. So if that's where we stopped, we just stopped right there, okay? That would be a deduction for GE, okay? And 30%, if their tax rate's 30%, that is $9 million of tax savings, correct? So if the only two things that existed was the first two prongs, GE could get a $30 million deduction, And that $30 million deduction saves them $9 million of tax. So GE now takes, in the other thing that I neglected to say was that this payment is made 10 years later, because there was some sort of payment stream associated with that $30 million lawsuit. So GE goes to our good friend Jim Belay down in LFS, gives Jim Belay this $9,000 or $9 million. Jim Belay gets him a 10% return, some number, and magically the tax savings that we did and we reinvested, we just used the government's money, invested it to pay off that liability. The government didn't like that. So they said, even though you have all events that have been met to secure the liability, you've been sued, you lost the suit, there's no way you're getting out of it, you owe the $30 million. The liability is determined with reasonable accuracy. We know what they owe. Well, you're not going to get the deduction until you pay it, because we're not going to let you use our money, the government's money, to invest that to pay off that liability. So economic performance, there are certain categories, and we're going to, I think, touch on them at some point in the middle of this, that economic performance is only going to occur when payment occurs on that. And warranty is one of those items. Sam, who you want to call in?
Max.
Does the IRS require to use cash basis or accrual basis methods of accounting? The IRS never mandates the taxpayer to use the cash basis method, but taxpayers with certain fact patterns are required to use the accrual method. Examples. Note some examples may not be 100% correct. Googling is a thing. One, C corps with past 3 years annual gross receipts of more than approximately 25 million, inflation adjusted. Two, partnership with a C corporation as a partner. Same gross receipts test. However, I believe that the test is applied at the C corporation partner level and not the partnership level. And then three, a taxpayer that carries inventory for sale to customers and has an average annual gross receipts of more than 25 million.
Okay, so let me ask a silly question, Max. If we have a taxpayer with an AR of $10 million, equity of $10 million, P&L of $10 million, and then this is year one of operations. Be a nice business. On the accrual method of accounting, assuming a 30% tax rate, how much tax do they owe?
About 300,000.
$3 million.
3 million, sorry.
Yep, $3 million. Do they have any cash? They don't. So on the accrual method, they now owe $3 million of tax. Do you think they would prefer to be on the cash method?
Yes.
They would. Okay? So what the IRS says is fine. We understand that there's a disparity in between the timing of cash and being on a cash basis makes more sense. But they said, well, wait a minute, there's a category that we're not going to let you be on cash basis. And one is a C Corp with annual gross receipts of the prior 3 years of 25 million, a partnership that has a C Corp, and that C Corp partner has annual gross receipts of 25 million. And where that's a real pain in the ass is what happens when you have P1, which is owned by P2, which is owned by P3, which is owned by a C Corp. How the hell are you going to know at P1 through that chain that there's a C Corp involved? I hate it. So I just assume it doesn't exist. Somebody's going to have to tell me. Okay? But let's say that this is a nurse staffing company. Okay? And let's say that this is 30 million, 30 million, and 30 million, and our average gross receipts are, for the past 3 years, something more than 25. If this is an S corporation or partnership, can we be on the cash method?
Yes.
We can. If we're a C Corp, can we be on the cash method? No. Okay? So S Corps and partnerships have a different opportunity to be on cash method versus C Corp or a partnership with a C Corp, even though there's this annoying chain. Max, who you want to call on?
Carter.
Assuming no requirement to utilize the accrual method, can a taxpayer choose which accounting method? Yes, they can choose, but once chosen, they are required to ask permission to change the accounting method. When an accounting method is changed, the taxpayer is required to quantify all of the past items that have been reported and true them as if the taxpayer used that accounting method in the past. This is called a 481A adjustment.
Okay, let's stop there for a second. Okay, so Carter, you get called on a lot. And actually, I find that funny. It goes to you quite a bit. But the first class, there's this kid, or you guys know him, Jimmy Nicola. Okay? Jimmy forgot his bag and for the first night. And Jimmy went home and didn't stay for the fun activities. So the next day, I'd say, Max, we're going to interact. Max, who you want to call on? Jimmy. Jimmy, who you want to call on? Chris. Chris, who you want to call on? Jimmy. And it just kept pinging right back to Jimmy over and over and over. And I'm like, what the hell is going on here? Well, since Jimmy went home, they all conspired and said, no matter what, right, whoever it is in the class, we're all going to bounce this back to Jimmy. And I wouldn't say that you got the Jimmy factor, Carter, but it seems to come to you quite a bit.
I think it goes to Chris a lot. I think Chris has been the Jimmy.
You think so?
I do not want to be the Jimmy.
You don't want to be the Jimmy?
No.
But it was super funny. It didn't take me long to smoke out because it just kept bouncing right back to Jimmy. All right, stupid question though. If this is on cash basis, and this is our first year, how much taxable income have we reported? 0. Because our AR, zero beginning AR was 0, ending AR was 30. We get to back all that out, we reported 0. And for whatever reason, we decided that we wanted to change our accounting method. And we do a form, God, what's the form number? 3115. I'm ashamed I couldn't remember it. 3115 is the accounting method change form. And we say, hey, IRS, we want to go from the cash method of accounting to the accrual method of accounting. The IRS has 2 types of changes, or 2 types of categories to change. One is automatic, meaning you can just say, hey, I'm changing to it. And one is non-automatic, meaning they have to give approval. So there's 2 categories. Changing to the accrual method, from cash to accrual method, is an automatic change. So now you say, well, wait a minute. How much income, if I had been, Carter, on the accrual method, how much income would I have reported?
Pick up 30 mil.
I would have picked up 30 million. So they say your starting point, how much did you pick up as a cash basis taxpayer?
0.
0. How much would you have picked up as an accrual method taxpayer?
30 mil.
30. So this 481 adjustment that is being referenced here is comparing and contrasting what you did report to what you would have reported if you were on that method. So in this case, that was 30 million. And I'm going to change it now to 28 million because my math's easier. It's all about me. Let's just be, is that right? 28 million? It's 28, I think. What's 28 million divided by 4? I'm being a dumbass here. 7. That's what the number was in my head, but it just didn't feel right. Okay? So this 481A adjustment says that you're going to take that 28 million, divide it by 4, and we're going to allow you to bring in that variance between cash basis of 0 and accrual basis of 28, and you bring that in on a 481 adjustment over a 4-year period.
So you're not really picking up like the 30 mil. You're doing an adjustment for the 30 million over the course of 4 years to pick it up as income. So it's almost like an installment.
Yep. 100%. Okay, Carter, who you want to go to? Not Chris, evidently.
Jackson.
Sounds good. If you were advising a taxpayer in their initial year of operations, what are two very good initial questions you ask to assist in the determination of which method of accounting, which accrual on the balance sheet will be larger, one, accounts receivable, or two, accounts payable, and will the taxpayer have large amounts of deferred revenue?
Boy, what the hell does all that mean?
Not exactly sure.
Okay. Does that make sense to you, Austin? Why I'd be asking those questions?
Yeah.
Okay. I'm going to do 3 balance sheets. Okay. One is AR is 30, equity is 30. That's balance sheet 1. Balance sheet 2 is going to be AP 30, equity negative 30, 0, 0, 30, 30. Balance sheet 3, cash 30, deferred revenue 30, equity 0. P&L 0, P&L negative 30, P&L 30. Okay, 3 different balance sheets, 3 different fact patterns. And does that quantify accounts receivable, accounts payable, and deferred revenue, Jackson? It does. Okay, so Carter, going back to cash basis, how much income on balance sheet 1 would I be taxed on?
0.
0. Okay. Connor, on balance sheet 2, if I'm cash basis, have I paid the 30 of AP?
No.
No. So one of the things that would have been better for this example is if I said cash basis AR and cash basis AP are the same thing. Because I now have negative 30. I have a loss, a $30,000 loss, or $30 million loss, or whatever the number is, that's reflected on my P&L. And if I do the same thing, my beginning AP was 0, my ending AP was 30, I have a $30,000 add back that takes my P&L to 0. In the exact same way, it eliminates that deduction, in the same way it eliminates the income on the first balance sheet. Does that make sense to everybody? So, let me ask a question. Is it better, let's see, who was called on? Jackson. Is it better to report income you haven't received cash for, or wait till you receive the cash?
Usually you want to defer.
You want to defer
until later. So
100%. Okay. So for balance sheet 1, you would probably want to choose
the cash because
cash basis. So stupid question number 2. Is it better to take the deduction without paying it and get the benefit of it now?
Yes.
Yes. So for balance sheet number 2, you would want to be on?
The accrual.
You would want to be on the accrual. Balance sheet number 3, well, anybody, this might be gift card worthy, what was the rule for deferred revenue? Recognition.
When paid. Or, sorry.
When
That's
paid?
wrong. Sorry.
That is wrong. That's okay. Wrong is okay. It was the $9,000 deferred revenue, Max.
You recognize like what you were supposed to recognize in the first year on GAAP basis and the rest in the second year.
And Max gets a gift card. Oh, almost taking out Austin's eye. Okay? So, if we have 30 million in cash, we're on cash basis, do you suppose we're going to have to recognize all 30 million?
No, but you'll have to
Are
recognize.
you kidding?
In the first year?
Hold on, no, for cash basis.
Oh, cash basis, yes.
Yes.
Sorry, I thought we were.
So, on cash basis, we're required to report all 30 million. But on GAAP basis, how much are we required to, in GAAP financials reported 0.
So it'd be no.
None. Okay? So recognizing what you're dealing with and helping the client diagnose what method of accounting they want to be on is a real thing. Because I've seen clients that have deferred revenue and what are you doing? Why aren't we on accrual basis? Or the AP is outpacing the AR. Why aren't we on the accrual basis? If they're have lots more AR, why aren't we on cash basis? Let's see, who was the last person?
Me.
Who you want to call in?
Matt.
Okay. We should give the all events test a closer look.
Oh, see, I probably did this ahead. You got an advantage here, Matt.
The first two tests are generally met if an item of expense is accrued for financial reporting purposes, but the economic performance test is murky.
Go ahead. What's number 15?
What are the subcategories of economic performance? The economic performance test is met if goods have been delivered to a client or if services have been rendered, or the economic performance test is met if the accrued liability has been paid.
Does that sound like what we talked about?
A little bit.
A little bit? I'm being serious.
Yes.
Is everybody clear through repetition kind of what that kind of means? And were you my expert guy? Who was the expert guy? We're not here to be an expert.
Chris is the expert.
We're here to learn something.
Fire hose.
Fire hose? Sam's diagnosis. What were
Am
you?
I the expert guy?
I think you're the expert.
I'm the
guy.
expert guy.
Are we here to be experts?
We're here to be not experts.
The answer, we're not here to be experts, are we? We should?
Yeah, probably.
So, I mean, we're not here to be experts.
Yep.
I mean, we're here to recognize these concepts exist, and to the extent our ability allows us to harvest as much as we can, to develop a point of reference, to know it exists, to build more later. So what you take away from this is economic performance comes in two categories. One is if a good or service is rendered, then generally economic performance is met. There's another subcategory where payment's required. That's the thing that you need to know. So there's two types of taxpayers. There is, from an accounting method perspective, what kind are they?
Cash and accrual.
Cash and accrual. Cash, when do you pick up the income and take the expense?
When you get the cash.
When you get the cash. What about accrual? Can you express when an accrual method taxpayer pulls in income and takes the deduction?
So for an accrual method taxpayer, you get the income when you earn it. You don't have to receive the cash yet.
Yep.
And you can expense it. You can accrue for expenses that you can accurately plan and calculate in the future.
Okay. So the fact that I can accurately plan and book it on my financials is that everything I need to measure in terms of being able to take that deduction.
No, I believe there's 3 parts.
And what are those 3 parts?
I'm trying to recall the.
Phone a friend.
Let's go, Chris. So the first one was the all events test. And the all events test talks about essentially all events have occurred to establish this liability.
Yep.
Second one is, like Matt said, you can easily determine the amount of the liability.
Yep.
And then the third one talks about economic performance.
Yep. And which of those 3 is the hardest?
Economic performance.
Okay, economic performance. And why is that of the 3 the hardest?
I mean, it's 2 prongs. So if it's goods or services, it's when the goods have been delivered or when the services have been rendered. And then the other category is harder to think about.
It's not harder to think about. It's actually easier to think about. It's just harder to quantify.
Harder to quantify.
It's when cash is paid.
Yep.
Like going back to the GE tort liability where they were sued for $30 million, you can't take all events have occurred. It's quantifiable because the judge says you owe $30 million, but we're not giving you that deduction until paid. And there's categories that come along those lines, okay? Actually, you're almost that close to a gift card. I mean, that was pretty good. How you guys feel? Should I give him a gift card for that?
Be nice to me.
Allie, why are you shaking your head no? You know what? That deserves 2 gift cards. If that's true. Did you really make it take a shot?
Yeah.
And you complied?
Great teacher.
Okay, you get 1 for taking the shot. Okay. So, let's see. Chris, who you want to call in?
Mac.
No,
They're doing it.
we are not going to do it. Are we going to call? Okay, I'll let this stand for
All
a
right.
little while. We'll see what the hell happens.
Okay.
Is this because you went to bed at 9?
I didn't go to bed.
What time do you go to bed there?
Like 10:30.
10:30. Okay. What's 16 say, Matt?
16 says application of the all events test to accrued expenses. So you have your vacation accrual, economic performance is when paid, and there's relief that allows payment within the first 2.5 months of the next year.
Okay, so specifically with accrued vacation, it says all events. You know what your vacation accrual is at the end of the year. It's a fixed liability because we know what it is. We owe it to you. If you leave the company, I think Nebraska requires us to pay you that out. So it's a known liability that we have to pay. So the first 2 prongs have been met, correct? So the second piece is, well, wait a minute. Accrued vacation says economic performance has to include payment versus a good or service being provided. Because you as an employee, you provided your good or service by doing a tax return or whatever it is that you're doing, correct? So it almost falls under that category. But when it comes to vacation, they say, no, we're not going to allow you to take that full amount because you may not take vacation. You may be a hard worker or think that we're going to fire you or whatever it is that you're thinking to do that. So let's see. If I know my vacation accrual is $100 at the end of the year on December 31st, do I know what my amount of deduction is? I do.
Yes.
Are you sure? Read it again.
No, because it has to be paid within the next 2.5 months.
Has to be paid in 2.5 months. Brett, do we ever shortcut? How often do we go to the client and say, okay, give us an exact reconciliation of what you paid? How often do we do that?
Maybe not as much as we should.
Maybe not as much as we should, but do we do this mathematically?
Yes.
We do. Okay? So what we do is we take this divided by 12. We're going to make that 120 just because that's going to be easier. Which gets 10, right? So now I have the number of months times 2.5 is 25, right? 0.5. 25. That is the amount. So when I have my income of 1,000, I know embedded in that 1,000 is $100 worth of vacation accrual, or 120. So I add back the 120 because I got to back out my GAAP accounting, and then I have to I got to back out my GAAP, and then I got to take my tax, M1, of 25. So now we're at 1095, correct? Is that math right? Does that make sense? So it's when paid. Economic performance with respect to vacation accrual is when paid for the first 2.5 months. Who would you like to call on?
Max.
What's the next thing? Say Max.
Accrued bonuses. Economic performance is when paid. There's relief that allows payment within the first 2.5 months of the next year. However, the mere accrual of the liability does not meet the all events test. This also has a requirement of being reasonable, estimable. The bonus is discretionary. It is not deductible until the year paid. If the company says there is a bonus, it will be determined once the financial results have been completed. In other words, at the discretion of management, bonus amounts will be set when the financial results are clear. If the board or management set the bonus amounts at 12/31, then the reasonably estimable standard is met. And then if the board or management set the bonus as a percentage of financial results, then the reasonable estimable standard is met.
Okay, so let's talk about what that means. Brett, do you know this rule? Okay, that was being sincere. I wouldn't. Okay, so when it comes to bonus accruals, okay, I'm going to just say on one side, you just have the straight up accrual of $100. And then I'm going to put the second one, determined after year end. And to me, as a staff person, you probably want to highlight this piece to be able to ask the question of what, because we didn't highlight vacation accrual because it's taking the vacation accrual divided by 12 times 2.5. That's a constant, that's a linear. You can commit that rule to memory. This one is a little bit different. This one says, okay, I accrue a bonus of $100 at the end of the year, but then there's this other piece that might be determined by profits. It might be, well, we're going to do our GAAP financials. Well, I got to figure out exactly where I stand after year end. There's lots of analysis I got to think about before I set that bonus. The IRS says, well, wait a minute. The more nebulous that is, the more we're not going to give that to you as a deduction. Okay, so this is two categories, determined after year end and accrual. So I know I'm going to give Max a $100 bonus because he was a good employee all year. That, there's no doubt, I owe him the money. I've accrued it, it's on the balance sheet. I print a 12/31 balance sheet, it's there. Everybody knows it's there. But then I say, Matt, who evidently is going to be insufferably picked on for a little while, is, you know, we're going to see how much picked on he gets to figure out how much his bonus is. Is he going to get picked on 4 times, 10 times, 20 times? What exactly is going to happen to poor Matt here? Okay? So the bigger that bonus number is, the more he gets picked on, the bigger the bonus. Okay? But I now have to figure out, you know, what is it $1 per pick on? Is it 100? Or what is it? And I'm going to talk about that after year end to see how he is, because I don't want Matt to leave and he's going to suffer, so I got to counterbalance it. Okay? So, at the end of the day, the more it's not fixed, the more the IRS is going to push back and say, you don't get that. Have I ever seen that on an exam, Matt? IRS exam. There's only one answer.
Yes.
Yes. The IRS is in tune to this issue. So if you say, well, you know what, I got to figure out if I got $1 million of income or $2 million of income or $3 million of income, and then I am going to make a determination of how much that bonus is. That determination is coming after year end, after our auditors come in and make all their adjustments and do everything they're supposed to be doing. So the more it's like that, the more they're going to disallow that, and economic performance in this 2.5-month rule doesn't apply. But if I say, you know what, I have a formula, and that formula says, and it's board approved, board agrees to what's going on, I'm going to take 10% of my GAAP net income, and I'm going to pay that 10% out. Okay? So now at 10% of $1 million, $100,000. Now I know I have a bonus accrual of $100,000. So then the next question really turns on, well, I got $100,000. Am I going to give that to? Now if I don't determine, I'm going to give 10% of that to Matt, you know, 20% to Jackson, and who that percentage is going to, the IRS would possibly push back and say, well, you've determined the amount, but you didn't say who it was going to. So they pick on they pick on this piece. So as a staff person, when you see the accrual, one of the questions that you could possibly ask, and I guarantee it'll blow the manager's mind, because how often have you been asked this question?
Not very.
Not very. But this is a real issue that you could say, hey, is all this bonus, was it truly fixed and determinable at the end of the year pursuant to, did the board make a recommendation? Was it formula? Was it a hard number? What was it? Okay, so that is a question that's worth asking. Let's see. Does all that make sense? Yeah.
So could companies like set a, like, at the end of the year, we're gonna give X% and it's gonna go to, so these 5 people to like meet the standard of reasonably estimable and then change it? Like,
What do you mean change it?
we said we were gonna give it to these 5 people, but like, we don't really know because we just wanted to meet the requirements so we could take the deduction, but like actually we're gonna switch it and give it to these 3 other people and
You're a CAS person, right?
Yep.
You think like a tax person. So this is the real way that happens, okay? And we'll cut this piece out. Don't cut it out. I don't care. Is what might happen is, all right, look, I don't know what the bonus is. And I'm waiting until I figure it out. Okay, whatever. Don't talk to me about it. I don't need to know what you do behind the scenes. But if you have board minutes, wink, that say that you gave the bonus, wink, and the board minutes are dated December 31st, wink, am I going to question when that actually happened? Probably not. So if they have the documentation in place and we can produce it contemporaneously with an audit, no problem. So, but we aren't going to audit whether they are doing that or not. But we might have said, hey, you got board minutes, don't you, on an IRS? Oh, you bet we do. Here they are. You know, so it does happen, maybe. The world's maybe not as honest a place as you want it to be. Let's see. Who was the last person? Is that you, Max?
Yes.
Matt, who do you want to call on?
Let's go Connor Boyd then.
Who? Oh,
Connor.
Bad debt deduction. One, economic performance is when the AR is specifically written off.
Okay, so I assume everybody's in tune with what a reserve is. So I'm going to bill $100,000 a year. I know on average 10% is bad. And you see this specifically, which I'm not even going to talk about that. I know 10% is bad. So 10% of 100,000 is 10,000. So debit AR, 100,000, credit income, 100,000. I know 10 of it's bad. I don't know who's bad, but I know 10 of it's bad just based on experience. So I'm going to credit AR for 10 and debit bad debt expense for 10. In that case, I don't know who the bad AR is. The IRS says, you can have a reserve, but we're not going to allow you to take that as a deduction. So a bad debt reserve is not deductible for tax until one of 2 things. You actually say, I'm writing off this AR. Brett Holtzen isn't going to pay me the 10 grand. He happens to be the guy that didn't pay it this year. So I write off that AR. That's the moment I can take it. Or, you know what, my bad debt experience isn't 10%, it's 5%, and I reverse that out and take my reserve down from 10 to 5. Those 2 instances, that would have a P&L impact for tax for write-off purposes. Okay? Depreciation, we talked about yesterday, correct? Gain loss on the sale of assets. Let's see. Carter, what's my definition of proceeds, just so we know where we're at?
Cash, property, and then debt relief.
Cash, property, and debt relief. So, can Allie, when I say there's a difference between gain loss on the sale of fixed assets, can you articulate why there would be a difference in gain loss for fixed assets for tax versus GAAP?
Probably your depreciation, like book depreciation versus tax depreciation.
Okay. Is everybody on board with that concept? Do we need to go over that concept? Okay. And if one person said yes, we should stop and do it. Okay. But everybody seems comfortable with that concept that my book depreciation was $100 on my $1,000 asset. My tax depreciation was $1,000 because I got bonus depreciation. Now they have a GAAP basis net book value of 900, tax net book value is 0 because I took 100% GAAP or tax bonus depreciation. So my basis for the calculation of both those is different. Therefore, I'm going to have a different gain for book purposes than I am tax. That seems like a solid concept in the room. Yes? Okay. Deferred compensation. Allie, who you want to call on? Oh, okay. Let's see. Luke, go ahead.
All right, deferred compensation, so you got three options. Non-qualified stock options, where economic performance occurs when this is paid. GAAP writes these off over time. And then ISOs, Googling is a good thing. This is a multi-level decision tree. There are qualifying and non-qualifying dispositions that dictate the treatment. And then deferred compensation arrangement. Economic performance occurs when this is paid, and GAAP also writes these off over time.
Okay, so here's the punchline. Okay, for non-qualified stock options and deferred comp, it's written off today or as paid. So, who you want to call on, Luke?
Matt.
Matt, do you know? Can you describe the taxability or what happens with a stock option?
Isn't it taxable when received and then
Can you tell me what an option is?
a stock
A
option?
compensatory stock option, a non-qualified compensatory stock option. Because this is worth knowing.
I have an idea of what it is, but I don't believe it's the right answer, so I'm gonna say I don't know.
Okay. All right. Who you want to go to?
Let's go with Sam.
Sam, do you have a shot?
Kind of similar boat.
Okay. Does anybody know anything about an option? Okay.
Isn't it like after a certain point in time, they get the option to buy a stock at a certain price that would be more beneficial than like the market price?
Well, that's the only time you would do it, but yes, that's exactly right. Okay. So you say in order to put incentives to keep people around, Lutz would issue Jackson an option to buy shares in Lutz. I'm going to pretend today's price for Lutz is $100. And we say, Jackson, if you're here 5 years from now, we will give you the option to buy Lutz stock at $100. We don't care if it's $101. We don't care if it's $1 million. We're going to let you buy that stock for $100. Okay? So Jackson's here 5 years later. Brett has provided excellent leadership, and we've gone from $100 to $500. And we're just going to refine it to one share just for ease. Okay? Would you want to buy a stock that's worth $500 for $100? Yes. Code section 61, does anybody remember what that says? What you got, Luke?
Is that like what income is?
Anytime you have, yes, income. It defines income. So anytime you have an accession to wealth, 61 says, unless there's an exclusion, it's income. Did you have an accession to wealth? How much?
I got $500 of value.
Yeah, but how much did you have to pay for it?
Oh, sorry, 100.
100. So there's $400 of accession to wealth. So on that stock option, we would give him $500 of stock. He pays us 100. We now give him a W-2 for $400. Okay, and that $400 is now goes through his W-2 and it's now subject to withholding. And since we gave him the 400, it's going through his W-2. At that moment, that's when we have that that M1. Hold on, I'm going to make one more point. So GAAP purposes, they would say, okay, that option, that $100 option, they do something called a Black-Scholes calculation to say that option when issued is worth $150. So the company takes a $150 deduction in year one, or however they do it for GAAP. This is going back to Austin yesterday, saying, don't reinvent the wheel. Ask the auditors how they're taking that option expense into GAAP expense over time, so you know what your GAAP M1 is coming out. In my example, so I'm going to take my I'm going to change my 110 to 120, okay? And I'm going to say that is taken in GAAP expense over 2 years at $60 per year. So year one, GAAP is going to have a $60 expense that we don't get for tax. In year two, we have a GAAP expense for $60 that we don't get for tax. So we have an M1 in year year one and year two, that's a $60 add back. Because according to this, economic performance for tax does not occur until paid. Okay, we haven't paid him anything. So we get to year 5, it's now worth $100, or worth $500. He exercises it. We now have a $500 or $400 W-2. GAP's already taken the expense. So in that moment, GAP's not going to take an expense because it already has. It's fully done it under the Black-Scholes methodology. So now, we now have a $400 M1 for tax that's a reduction in income by virtue of paying them. Okay, so now this is worth knowing. Okay, and I didn't even know I was going to do this. But knowing things, especially when you're going to hear a term called, let's see, I'm going to assume a 20% tax rate. Okay? And I'm going to assume that we gave Jackson 4 shares. Okay? So what happens is, how much was your income, Jackson?
It was 400.
400. Okay? So 400, Jackson, 400 times, what's my tax rate?
20%.
20%. What's my tax? Ah, fuck. It's not close enough.
50.
It's 80. Did you say 50?
Yeah.
You know, I say stupid math all the time, too.
Sorry,
Okay.
the 10 keys.
So, I was hoping my math was going to work a little bit better here, but it's not going to. There's something, this is called the cashless exercise. And you might hear this term. The only reason I bring this up, you actually might hear this term. Okay? The cashless exercise. So, we ran something through your W-2, Jackson, and it's going to result in $80 of income. Where's that cash going to come from? Are you going to cut a check to the company for $80? Nope. Probably
It's
not.
my own, whatever.
No, it has to go through your W-2.
Right, but
So
how am I gonna pay the tax? You mean, or?
No, Les has to send $80 to the IRS
Oh yeah.
when they give you the stock.
I withhold it on the W-2.
From what?
There's no cash though.
There's no cash. Where's that cash coming from?
Would it be my active, like, wages?
Nope. Because we pay you $1.50 a day.
Okay, so I don't have enough.
I mean, generally, this exercise is going to way outpace
Okay.
what's on your W-2. Okay? So what we do is we say, look, man, we're going to take 1 share back for tax and leave you with 3 shares. So now we were required to send the IRS $80, but we took out $120 because we gave you 4 shares. I should have made it 5 shares. I'm an idiot. And now we're going to use one of your shares or some level of shares to fund the withholding that we have. Okay? That's how that's done. It's called the cashless exercise. Got a question, Carter? You look intellectually curious back there. Okay? So deferred compensation, Jackson's able to say, I earned $500 this year, put it away, I'll get it when I'm 59 and a half. When he turns 59 and a half, he gets his $500. We withhold the $100 or $80 from that amount. That's how that works. He gets paid. We actually have a cash source to withdraw from. That's how that works. ISOs, I hate ISOs. ISOs were really, really, really big in the 1990s and then early 2000s. And so we're going to grant an ISO of $100 to Allie. You know what ISO stands for, Allie? It's called an incentive stock option. Okay? And so we're giving you an ISO or an incentive stock option, Allie, for $100. And one of 2 things is going to happen. And this is where I say, what did I say about Googling? Googling is a good thing. So what I'm telling you is 80% correct. Can you do any better than me on ISOs?
Not even close.
Okay? I hate them. Okay? ISOs, there's one of 2 options. Okay? There's qualified exercise and there's non-qualified exercise. Okay? A qualified exercise means that I issued you something $100,000 or less of an ISO, which we have $100 up here, and from the date you're granted that ISO, you can't exercise it for a period of 2 years from either the date of grant or date of exercise. I can't remember which. I think it's date of grant. So again, everything I'm telling you, there's 2 answers, Chris?
Correct answer.
And I'm in the I don't know category right now. I'm telling you what I think I know. And by the way, when you're interacting with a client or a manager or whoever, starting with, here's the stuff I do know, because that's what I'm doing right now. Here is what I think I know. I don't know that I know it, but here's what I think I know. I think I know that an ISO from date of grant, not date of exercise, as long as you hold it for a period of 2 years, it falls in the qualified bucket. If you exercise or dispose of that ISO within that 2-year window, I think from grant to date of exercise, then it's non-qualified. So non-qualified is exactly what we just talked about for options. So a non-qualified ISO exercise has the same tax impact that we just talked about for non-qualified options. Exactly the same. With a qualified, here's the thing. You have regular tax and you have AMT. Max, what does AMT stand for?
Alternative minimum tax.
How do you feel about that, Chris? You think he's right? Allie, is he right? Perfect. I love it. She said, I don't know. Alternative minimum tax. What's that? If you're going to explain to Allie, your peer, what alternative minimum tax means, what's that mean?
It's like a floor on the effective rate of your tax if you're in a high enough tax bracket.
Say that again?
It's like a floor on your effective tax rate.
Okay, since I know what you're talking about, that's not a terrible answer. But Allie is no better for that answer, I don't think. Okay? I don't think. Did that help you at all? The sureness of your voice leads me to believe that that's not right. Okay? So regular tax and AMT. Okay? There's income, I'm going to say, of taxable income of 100 and 100. Okay? So what happens, you go to the form, and by the way, this has become way less of an issue since the Trump tax cuts in 2017. Because the fact that you don't know this was much more prominent of an issue prior to 2017. What this does is says, all right, you have income for both, and under the old rules, okay, pre-Trump tax cut, Allie, do you have an idea what the SALT cap, state and local SALT cap max amount is? Carter?
10,000.
10,000. Okay? We have a $10,000 cap on SALT. But prior, it could be way bigger. Okay? So we say, okay, I'm going to revise this. We have state and local deduction because I have a California house. Okay? And my taxable income, let's see. ISO. My taxable income is 60. Okay? So now you have this regular tax calculation. The punchline where I'm going with this is AMT is a parallel tax calculation. So when Max says we're searching for a floor of the tax to be paid, that seeking of the floor is by virtue of 2 tax calculations being performed at the same time. And you take the greater of the 2. Okay? So if I take this times 30%, that's $18 of tax. But now for AMT purposes, so you see I got ISO at 0 here. So an ISO that falls into the qualified tax or qualified option results in 0 taxable income for regular tax. Well, that sounds nice, doesn't it, Max? Oh, it does. Okay? But for AMT, they say, it's $100. So now I got to go from my regular tax calculation column to do my second tax calculation column to figure out which is which. So now I have $100 of income. I get 0 deduction for state and local. And then I have $100 of income because of my ISO, which gives me $200 of AMT taxable income times, and I'm going to say AMT comes in at a lesser rate. It's not, they use a different rate system of 20%, $40. So under the AMT calculation system, there's $40 of tax. So now I've found the floor that Max was referencing. So when you look at the 1040, the 1040 is going to say regular tax of 18, and then it's going to say AMT tax of 22 to get to the 40. So my AMT tax is $22 because it's the variance in between my regular tax and my AMT tax. So there's 2 taxing systems. So for non-qualified stock options, we have this cashless deal, can't deduct it till paid. ISOs, Google it, because I kind of gave you what the boundaries are. I can't remember what they are. They were very popular in the 90s and 2000s until the tech bubble crashed. And everybody that paid AMT, they took their $100 and the tech bubble crashed and it was worthless. They said, why the hell did I pay AMT when I didn't get $1 out of this? What just happened to me? They fell out of favor due to the 90s or 2000s. Deferred comp, not deductible till paid. Let's see, Allie, who you want to call in? Matt. She's sticking with it, Matt.
All right, we have reserves, there's inventory, and economic performance occurs when this is paid and GAAP writes these off over time. Then a warranty, economic performance occurs when this is paid and GAAP also writes these off over time.
Yeah, well, okay, so let's just stick there for a second. Okay, anytime there's a reserve, generally it's not going to be deductible. The only industry, there's 2 categories where reserves are deductible. One is insurance companies, and the second is banks. I think banks. I don't know. I'm sure insurance companies. Okay. How many banks and insurance companies do we do, Brett?
I think 0.
I would go with 0. The banks, I think we do some banks. But I'm sure we don't do any insurance companies. At least the insurance side of the insurance company. Okay? So reserves, anytime you see a reserve, your default, your starting point should be it's not deductible. Okay? Matt, who you want to call in?
Let's go Connor McCraddock.
Letter H, change of accounting, 481A adjustments, positive adjustment written off over 4 years, negative adjustment written off in the year of accounting change.
Okay. So we talked a little bit about this yesterday, right? That said if we change a method of accounting from cash to accrual, I'm going to do it 2 ways. I have AR of $100, equity of $100, okay? And this is on cash method. Max, since we're on cash method, how much have we paid in tax? 0, because we haven't collected the cash. Okay, we do a 481A adjustment. This says you have to quantify what amount we would have been taxed on if we were on the accrual method and compare it to what we have been taxed on the cash method. How much have we been taxed on so far, Connor? On cash basis? 0. How much would we have been taxed on accrual?
100.
100. So this says you have to take that variance in between those 2 amounts, divide it over 4, and report it over 4 years. Okay, so now we're going to have year 1, 2, 3, and 4 of 25 per year, correct? Okay, so what this is saying, if we do that, now we have a $25 M1 that's going to roll through our tax return over the next 4 years because we did a change of accounting method. Okay, so now let's change the facts a little bit to say this is AP, what's the rule up there say? Well, the cash basis. How much deduction have we taken, Connor?
None.
None. If we were on the accrual basis, how much would we have taken?
100.
So now we have to do the variance, correct? So what's my variance?
100.
100. So what's my rule say? A negative adjustment.
Written off in the year of accounting change.
Written off in the year of accounting change. So we would have one M1 in year one of $100. And you will see 481A adjustments as an M1 on your tax return. Not often, but do you see them? Every once in a while. Oh, fuck. Okay. Matt, who you want to call on?
Let's go Carter.
Carter, what's this say?
Deferred revenue, year one, to the extent that deferred revenue is recognized for financial reporting, it is also recognized for tax. The amount not recognized for financial reporting can also be deferred for tax. Year two, the amount recognized for financial reporting is recognized for tax. The remaining amount is deferred for financial reporting, or the remaining amount that is deferred for financial reporting is recognized for tax. Stated another way, 100% of the deferred revenue is recognized for tax purposes in year two.
Does that sound right? Uh-oh, you look like you have a furrowed brow. He might have busted me on something.
No, the wording was interesting, but I think the last sentence got it right.
Okay. Well, fire away, man. I mean, anytime you want to interject, that's why you're here.
Yeah, it's just
You're a translator for the old guy.
basically if you try and defer revenue for financial purposes past 2 years, you can't do that for tax. You have to take it all by the second year.
Okay. So, again, we talked about yesterday, if we had $100 of deferred revenue, GAAP recognized, or 900, it was 900, right, Jackson?
Yeah.
900 is what we said. And GAAP recognizes 300 over a 3-year period. In year one, GAAP recognizes 300. For tax, we have a 300. So let's do it in terms of M1 just to make sure we're all on the same page, right? There's 900 of deferred revenue, which really turns into 600. 900 of cash, 300 of equity, because my P&L is 300. So this is cash, because deferred revenue is debit cash, credit deferred revenue, equity. We recognize 300 for GAAP, right? So my M1 in this year is 0. Okay? This is year one. Year two, it says my P&L is going to be 300, correct? Because now we've recognized 300, 600, 900, correct? But I'm going to have an M1 of 300 because I have to recognize the full amount. And deferred revenue has to be recognized by the end of year two. And when you have these multi-layers of deferred revenue year one, deferred revenue year two, deferred revenue year three, this turns into a reconciliation process that you as a preparer have to confront. Is that fun, Brett?
No.
No.
It's hard to figure out the buckets.
So would the remaining 300 have to get dispersed by year three then?
Okay,
For
so
deferred
you know
revenue?
what, that's a great question, Connor, because year three, you're going to have 300 for GAAP, but by virtue of recognizing the year before, you get a deduct for tax because GAAP is over-recognizing in year three because we've already recognized everything in prior years. That's a great question. And that was a failure on my part to be paying attention. Can you pass that back, please? Oh, fuck. Sorry. Okay, this is going to be a guided tour because I don't remember what the hell that I did here. So I'm going to be guessing just right along with you guys. But what I think I'm doing is I'm saying I'm probably, don't throw pitchforks and spears at me if I'm wrong, is I have a 2021 balance sheet, 2022 balance sheet, maybe somewhere in here is an income statement, maybe. that says at the end of the last year or the beginning of 12/21, 125 of cash, $1 million of cash, account receivable. I have deferred revenue on here. Yay, me. I like that a lot. Okay, so this is the balance sheet of the client that you're going to get when we prepare the tax return. Okay, I think is what's happening here. And we have, oh, look at this. We do have an income statement. We have revenue, cost of goods sold, wages, depreciation, inventory reserve, bad debt, deferred comp. Okay? So I'm presuming, okay? So this is the same thing. This is saying that the next page you might want to write, because I was not smart enough to do it. This is a cash basis taxpayer, is what this is. And now we're going to quantify what the M1s are for the cash basis taxpayer. Okay? So when the process of doing this is you're going to start with, okay? You're going to start with, I don't like this, book income. Come on. Okay, let's go over here then. You're going to start with book income of 615. Okay? Book income 615. And going back to what we talked about yesterday, when we said we were talking about cash-based taxpayers, in year one, we had $100 of receipts, $100 P&L, and we were able to back all that out, correct? Because it was year one activity. But year two activity, we went through and demonstrated, well, my AR at the end of year two was 20, and my cash at the end of year one on my balance sheet was 10. Do you guys remember this from yesterday? And it demonstrated that by fluxing the beginning and ending of the account is this year's M1 because that's this year's activity, okay? So the procedure for a cash basis taxpayer is, well, my beginning AR from the end of last year was $1.5 million. So conceptually, I know the procedure is I got to pull out my GAAP accounting in the process. Then I got an accounting method. Then I got to put in my tax accounting method. So I'm going to back out the $1.5 million of GAAP AR, or add back, excuse me, I'm saying that wrong. So let me do that again because I was about ready to do that pretty poorly. Okay? So Matt, who you want to call him? Because I know they're going to come to you if I ask anybody.
I'll do it.
Okay, so Matt, at the end of last year, 2021, I had $1.5 million
Yep.
of AR.
Yep.
Okay, and I really was going to do this really, really poorly, so now I'm glad I stopped myself. Okay, and I have a 30-day collection cycle no matter what. I don't have any bad debt, even though I have bad debt. We're going to pretend it works like clockwork. So December 31st of 2021, I had $1.5 million of AR. On February 1st, how much AR do I have left of that amount from year end?
The $1.5 million?
Yeah. Did I collect it all?
No.
Yeah. Well, I said 30 days.
Yeah.
So in January, I collect AR 30 days. Okay. So I've collected 100% of that AR because I do it in 30 days. On a cash method taxpayer, does that result in taxable income?
If you collect it, yeah.
Yes. So I take last year's AR and I add it back to my 615 because I know I collected it within the first 30 days. But I also know at the end of the year, I got $2 million of AR. That means I'm on accrual basis for that number. I didn't collect it, and I back it back out. So this results in I collected $1.5 million, but I reported $2 million in it in my P&L, which results in a reduction to that 615 of $500,000. Did that make sense to everybody? Okay. Bad debt's its own reserve either way. Okay. On a cash basis, there is no concept of bad debt because you never reported it through your income. But if you're taking that through your GAAP P&L, it's still an M1. Okay, so my beginning bad debt, my ending bad debt, you flux it Inventory reserve, it's a non-cash item. AP, Matt, do you see the reverse, or can you articulate the reverse for the AP if I pay all my AP within the first 30 days?
So at the beginning of the year, you had 400,000 in AP. So you're gonna take that out of your book income, and then at the end of the next year,
Why? Because you actually paid it, right?
you actually paid it during
Yep.
that year. And then for the current year, you have 500,000 on the balance sheet, but you haven't paid that, so then you have to add it back to your
Yep.
book income, and then the net of the two gives you your M1.
CV, how you feel about this? Clear? Allie, clear? The other Connor, clear? Okay. Okay, so it's the process of fluxing the accounts or checking the variance, and the thing that is probably going to be hard, potentially, is going, okay, wait a minute. On the AR side of things, the prior year balance, Jackson, is a negative or a positive?
For,
The M1. The AR is an add back?
oh, the AR?
Yep.
Okay, so we're adding the beginning balance.
You're
to
adding
our
the beginning
book. Yeah,
balance. And the ending balance, are you adding or subtracting?
we're subtracting it.
Okay. So is that the same thing we're doing with AP?
It's essentially the opposite.
It's essentially the opposite. So knowing the signs and why the sign's there in the M1, that's something that would be useful to know. Because, wait a minute, I'm flexing the account. Well, but exactly how are you flexing the account? You have to be smart enough to go, for the AR, it's an add for the beginning and a deduct for the end. For the AP, it's a deduct for the beginning and an add for the beginning, or a deduct for the end. Well, no, I said it backwards. You get my point, okay? Knowing how that works and why it works that way, because I collected the AR within the first 30 days, therefore I have to add it back. I haven't collected the end, therefore I have to deduct it from my P&L. I paid the beginning AP within 30 days, therefore that's a deduct. I haven't paid the AP on the balance sheet at the end of the year, therefore that's an add. Knowing that distinction probably will be helpful when you're doing your cash to accrual clients. Brett, how many cash to accrual clients do we have?
Quite a bit.
Quite a bit.
The way I think about it is, if my assets go up, my income goes down. So if we look at our balance sheet, our AR went up by 500, so our income is going to go down by 500. And liabilities are the opposite. Liabilities goes up, income goes up. So that's my gut check at the end to see if my accrual of cash makes sense.
I think we're still on cash basis. We are. Okay, so this is cash basis year 2, is my point. Let's see, Matt, who you want to call on?
Let's go Sam.
Sam? What do we start with, Sam?
Book income,
Why do we start with book income?
because that's,
The auditors have already ran everything they're going to run through book income, and it's our universe. Now we have to figure out where we account for things differently. Okay? So walk me through each of those M1s just for the hell of it, Sam, to tell me why we're doing what we're doing.
all the beginning AR. And
Yep.
so we add our beginning AR to book income because that is things that we paid and in that year and
We collected.
or collected. Yeah, sorry,
Nope,
we
you're good.
collected in that year, and so from a cash basis standpoint, that's when we earned it.
Yep.
And so we add it to our income, and then we subtract our ending accounts receivable because from an accrual basis that decreases it, but from a cash basis, we haven't actually collected it yet, so we can't count it as income.
Yep.
So we decrease our income.
Yep.
Bad debt is, let's see, beginning 75. So did we actually write it off as uncollectible then?
So let's talk about that. That's an interesting phrase. You're hitting the nail on the head. So going back to accrual basis taxpayer, going back to my $100,000 worth of AR, I do a reserve for $10,000, and I know I'm not going to get it, right? I don't know who it is. That's not deductible for tax under accrual method, correct? Accrual method tax accounting. But if I say, hey, I know Brett's not going to pay that, okay? I specifically know he's not going to pay it. So I can now write that off because it's specific, and I actually take it out of my AR, okay? And now that is a deduction for tax. So, but now let's look at that through a cash basis perspective. Did you report the $100 of AR because you're on cash basis in my example? No. So bad debt reserve, up or down, doesn't matter. Because even though I know I have a reserve against it, well, I didn't report it to income to begin with. Okay? If I specifically identify Brett's not going to pay me, I never reported his income to begin with. So that reserve from a cash basis perspective is almost meaningless other than the auditors are booking a bad debt reserve in the P&L. And we have to take that bad debt reserve out of the P&L and just push it out. That's the only reason we're doing that.
So we're just taking what they gave us and saying, okay, sounds good, we'll do that?
We're going to flux it every year. There's no analysis or thought process with respect to, do we have a specific write-off, how does this work, what's going on? That kind of thought process goes with the accrual method counting. Okay, so that's just truly is, what was my beginning, what was my ending, who cares? Because again, I don't report the reserve, I don't report anything in AR, since I'm from tax perspective, income tax perspective, therefore my reserve, up or down, shouldn't affect my P&L either way.
Would it be similar for inventory reserve? Or is that?
No, an inventory reserve would be different, because an inventory reserve from from cash basis perspective, you know what? That's a nuanced question and it's a nuanced question because I can't remember the income limit. Under a certain dollar threshold, you can write off inventory as if it was a supply. Over a certain level, you have to go to the accrual method. Do you know where those boundaries are?
No.
I can't remember where those boundaries are. Okay, so if this were truly written off, then yeah, it would be the same, 100%, because we've already written off 100% of it. So we're going to go with that answer, and I don't know on top of it. Okay. Okay. So what's next?
Accounts payable. So we are going to subtract out our beginning accounts payable because those are things that we paid this year. So it decreases our income. And then we're going to add back our ending accounts payable because we didn't actually pay the cash for them this year.
Correct.
And then accruals. So how would that work from a cash basis standpoint? Because do we have cash moving on an accrued vacation expense? We don't, right?
Nope.
So is this another one where we're taking what? We're just
take
flexing it?
Yep.
Okay.
100%. 100%. Deferred comp, same way. Deferred revenue, the same way. Because deferred revenue, there is no concept of deferred revenue for cash basis. Because as soon as we receive the cash, whether we perform the service or not, Sam, do you think we have to pick it up?
Yeah.
Yeah. For deferred revenue, do you think we get a deferral into year 2 the same way we do on an accrual basis taxpayer?
No.
Why? Because we receive the cash. And by definition, we are a cash basis taxpayer. So if we collect cash, income. We pay cash, deduction. So on deferred revenue, you now have to take it into income. Carter, how you feel about all this? Clear? Allie? Clear? CV? All right. The back row always are the people that sleep. I kind of like this. This I put together to say, to tie back a little bit to the accrual method of accounting, and we had the 3 prongs. Nally, what were they? Sorry, I caught you mid-drink.
Sorry, say that again.
What were the 3 prongs to measure whether something is reportable for income tax purposes under the accrual method?
wasn't it like?
Call a
Something
friend.
like
Phone a
all
friend.
events,
Yeah.
um,
Do what?
that's all I remember.
What was it? Sorry, I thought you were going to phone a friend.
All events have occurred, the liability can be determined with reasonable accuracy, and then economic performance has occurred.
Okay, so that's what this is. Okay, this is kind of a summary of what that concept is. You know, for cash, you really don't need to talk about it. For AR, is it reportable when the good or service is rendered, economic performance has occurred? Allowance for doubtful account, good or service, no. Economic performance is when you have a specific write-off of the AR. Inventory reserve, no. Good service rendered, but specific write-off of the inventory. Accounts payable, good or service rendered. Economic performance, yes. Credit card payable, yes. Oh, here's something that's, take your highlighter, highlight credit cards payable, and remember this rule. Okay? Because I'm switching from accrual basis for a moment to cash basis. If Lutz does service for me and they send me an invoice and I book that in AP, is that deductible for cash basis? No. If Lutz sends me a bill and I pay it with my credit card, but the cash hasn't left my account because it's on my credit card, is that deductible for cash purposes? Yes. It is. So that is a liability for cash purposes, even though it's a liability that your cash has not left the building. Credit card payments for cash purposes are deemed to be cash payment for cash method accounting taxpayers. Okay? I meant to bring that up earlier. Accrued vacation, no, but you have this 3.5 month rule. Accrued compensation, 3.5 month rule. And this is another place that you might want to get out your highlighter and give yourself a little bit of a note, because this is one that drives me nuts and we ignore it, and I think we do ourselves a disservice and the client a disservice by the virtue of what we ignore here. Okay? Amounts paid by 3.5 months. So I'm going to push that aside for 1 second. I am relatively confident that everybody in the room probably maybe has heard of Enron. And I think everybody in the room probably either studied Enron, ethics or otherwise in college. Maybe, maybe not. Okay? So, I hate this. Bad actors create lots of problems. Okay? Matt, who you want to call on? Max. Earlier I said, when is deferred comp deductible?
Deferred comp when it's paid.
When paid, okay? So, you gotta love this, okay? Enron. Enron took the deferred comp rules and they abused it so bad that they created a new regime. Or, I think it was new, I don't know. I don't know how new it was. I don't know if this was a bolt-on or whether this was brand new. 409 Cap A. 409 Cap A is deferred comp rules. Okay, and what Enron did, okay, was they said, okay, Max, we are going to give you $10 million this year as a W-2. Do you want all of it? No, I'm good. I don't want to pay tax on it. I want to put it into a deferred comp plan where I can take that out starting at age 59 and a half over a 15-year period to where it funds my retirement, and my tax rate I'm not going to choke on my tax rate. Okay, so people were stuffing lots into the deferred comp plans at Enron. So Enron was a shell of a company, but nobody really knew it, that it was a shell of a company. The shit that they were doing, has anybody read the book? Conspiracy of Fools, and I mean, the shit that they were doing, it was like, holy fuck. Okay, so now Max has $10 million in this deferred comp plan. So there's needs to be, well, we agreed you were going to take it out 59 and a half, right? Well, there's this, now we got to put a barrier. You know, you can get it out earlier, but there needs to be a barrier. And that barrier is, if you take it out early, Max, we're going to take away 10% from you. Okay? So, you get it out, what's 10% of $1 million?
1 million.
How much do you get of cash?
9 million.
9. Okay, so everybody at Enron knew we were on a sinking ship. And everybody knew that I don't know what the real number was, whether it was 100 million, don't know, but let's call it $100 million. So they said, I'm going to take my 10% haircut, because if I don't take my 10% haircut, I get nothing. So now $900 million exited Enron to their stake, the deferred comp holders, while the shareholders and all the 401ks just were experiencing an economic bloodbath. And Congress said, oh no, that's not good. So what they did was put in 409A to say, okay, if you max put something in deferred comp, then we're going to pin you down on the rules. And if you violate those rules, Max, we're going to take you out back and beat you around the head until you're bloody. And what they said was, you tell me the exact moment in time when you're going to take that out. And first of all, the first rule is, do you want your $10 million? And it's December 31st. And you say, nope, I want it in deferred comp. Versus, do you want your $10 million from last year on January 1st? One is a good deferral for deferred comp, one is a violation. Once you have to make your election to defer comp by the end of the year, okay? So we're going to pin you down. You got to cross every T, dot out every I, and if you don't, guess what? We're going to not punish the company, Max. We're going to punish you. We're going to make you pay tax on your discovery. We're going to charge you interest and penalties, and we're going to charge an extra penalty of 20%. So now your $10 million turns into $2.50 by virtue of all the interest, penalties, and tax that they're going to levy against you because you were a bad actor and took it out at the wrong point in time. Okay? So why am I bringing this up? This is so fucking stupid, I don't know what to do with myself. Is that there's, up to and including what we just described for Max, there is something called in the money options. Okay? So going back to Jackson, we gave you an option for $100, correct?
Yes.
Okay? So your option was 100, but if the fair market value, Jackson, was 200,
Yep.
that's an in-the-money option. An in-the-money option falls into this deferred comp. That I kind of get. Fine, fair enough. But the one I don't get is short-term deferrals. Short-term deferrals. Okay? So let's go back. This is a long way to get back to here. Okay? Amounts paid by 315. What 409A says is that if you don't pay your bonus, if you pay your bonus after 315, guess what you have? A short-term deferral. And the IRS could come in and say, you had a short-term deferral. Now, Max, you're an employee of Lutz. We give you a $10 million, $5 million bonus, whatever the number is. We pay it by 316. Does Lutz get punished? You get punished. Okay? So and we ignore this, right? I mean, we need to say out loud to partners, managers, clients, that this 315 short-term deferral, while the IRS has never pushed it that I've ever seen, because it's so ridiculous, the rule does in fact exist. Okay? Deferred comp, goods and services, no, only in payment. Deferred revenue recognized over 2 years. I tried to take the things that we talked about as from an economic performance, the three-pronged test and put it on here in something that might be meaningful, maybe. So I don't know if you guys want to put a post on that page or you care, but that's what that is. Okay, so I think this might be accrual method, M1s. Jackson, what do you think about this? Where do we always start when we're doing our M1 calc?
We always get our book income.
We always start with our book income because book income has every GAAP accounting method in there to quantify what that number is. Now we have to figure out what our tax accounting method, different accounting, tax accounting methods that are different to arrive at the variance to arrive to taxable income. Okay? So what's that first one?
Looks like we're adjusting the bad debt.
Yep.
And it's like we talked about, we're just fluxing the accounts or whatever, beginning and ending.
Yep.
And then looks like we're doing the same thing with the inventory reserve.
Yep.
And then, yeah, same thing down to the deferred comp we're doing.
Okay, so but let's talk about accrued vacation though. Right? That's the one that I didn't do it here. Might have been lazy, might not have remembered. I'm not sure which it was. Both are equally likely. Is that this is the one you might want to make a note on your page that you divide this by 12 times 2.5 to maximize what the taxpayer's deduction is. And do we do that commonly, Brett?
Yeah.
Except I'm stupid and I didn't do it here. Right? So let's see. Accrued compensation. I don't think that's right. I think I'm just catastrophically stupid. I don't know why I put that on there. That shouldn't be an M1 at all. Because accrued compensation is something where everything has been fixed. And tell me if I'm wrong, Brett. I think I just was being stupid here. Everything's fixed. The service has been rendered. I don't think there's a moment in time I've ever taken, except maybe sitting at my counter watching football, accrued compensation as an M1 I would flux. Put a big fat X in that one. That should not be there. But the accrued bonus is one that says, okay, is that paid within 3.5 months? Deferred comp, not until paid. Oh my. Recognized for book 2022, ending deferred revenue, $2 million for $500,000. Where the hell is that M1 coming from? What's my deferred revenue up there? 3 million? Well, I'm not fluxing that account. Happens to be 500,000, but that's a fluke. Oh my. What is this? Okay, so this is deferred revenue. I hate deferred revenue. Okay? So I'm pretty sure, and I think I probably did this poorly. As a matter of fact, I'm quite confident I did it poorly. The top section is my GAAP accounting. And going back to what Austin Sabalaska said yesterday was, talk to the auditors. Ask them how they're recognizing that for tax. Okay? For tax purposes, it's the, well, you recognize whatever in year one and the remaining amount in year two. So for deferred revenue, in year one, I have $2 million that I'm recognizing over 4 years. Year two, over 4 years. Year three, over 4 years. Year four, why the hell I used $666,000, God only knows. Have no idea. Okay? So the rule says that I have to recognize an amount for tax equal to what was done for GAAP in year one. Okay? And what year are we in? I assume 2023? Maybe?
We're in 22 at the top.
Might be
22?
Yeah.
Okay, so for, yeah, it's 22. Has to be. Okay? So for GAAP in 2021, we're reckoning the 500 and 500, right? For tax, we have to recognize the remaining amount from the previous year of $1.5 million. So for tax, I got $2 million of recognition for tax purposes. For GAAP, I have 3 tranches that are being run out for $1.5 million. And God willing, I hope that ties out to what my M1 schedule says. I got $1.5 million that I recognize for GAAP because I got to back out my GAAP treatment. I have $2 million for tax that I have to recognize because it's whatever the GAAP amount was for the current year plus whatever the previous year's deferrals that are remaining to be recognized at the end of year 2. And these schedules are terrible. I mean, you really for scooters, the gift card calculation on that, I spent 2 hours in Katie Bird's office saying, how the hell does this work? Tell me what you're doing for GAAP. And on that one, they had the reloading of a gift card. I'm like, what the hell are you doing to me? So, going back to my schedule, okay, they would say, you know what? Even though I got this $1.5 million recognized for GAAP, I know of this 2019 line, there's 500,000 still out there, and I get to 2023, there's 0 out there for GAAP. But I know that, Allie bought a gift card and she dropped it in her car seat in between her seats and she can't get it, and now that card is unused, or it got thrown into a drawer somewhere because nobody really wants a card, or I got into training, I really don't like scooters, so it's left in my car, whatever, okay? There's an amount that's unused in there. And what they were doing was harvesting that amount unused and reloading it on new cards. So now this amount that is loaded on new cards has been recognized for tax, but it looks like a new addition. I hate deferred revenue.